Hello and welcome. You're watching The Chartist on NDTV Profit. I am Agam Vakil, and in this show we try and try and decipher long-term trends, potential opportunities when it comes to Indian markets, largely based on what charts are telling us. Today is our first show of this particular series, and joining me for this one is Dr. CK Narayan. He's the founder of NeoTrader. Mr. Narayan, thank you so much for joining in. I'd reckon that it would make sense for us to take stock of the benchmark indices right at the top, what you're making of them, where are they currently, and where do we go from here?
All right, thanks for having me in, and happy to be part of a program that takes it off the beaten track that charts are purely for the short term or intraday. And here we are going to talk a little longer term, and that has been more my area of focus. So let's look at the index from what the short term is saying about the long term.
Right.
Well, you know, we can sum it up in 2-3 ways. First is that the market is absolutely not interested in going down.
Yes.
We had election results that took toll on the markets for a single day.
Yeah.
And then we pulled up to a new high. After that, one of the most feared things for the market came about, which is this long-term capital gains. And then the finance minister laid it on a little more by, increasing the short term also and adding STT increase for good measure.
Absolutely.
The market simply shrugged it off again. So if two of these biggest things, BJP losing the election or this long-term capital gains or any kind of tax for that matter, are not willing to send the market down, then it is very evident that this market has absolutely no interest in doing so.
Right.
In addition, we have all this ongoing stuff. We have been having a war in the Ukraine for about a year and a half. We have these skirmishes coming out of the Middle East every now and then. And earlier, all this used to spook the market a hell of a lot.
Yeah.
But those things have simply been brushed into the kind of background. So again, you're not having anything which is spooking the market in any which way except for a day or two.
Right.
In that context, we have to think that the long term is steadfastly up, in which case every dip that you get in the short term is something that is to be used for getting into the market rather than think about, the markets going down, etc.
Right.
Recently, we had the markets going down with a gap with that scare from Japanese markets, which everybody and their uncle were talking about carry trade, and I'm sure 90% of the people have no clue what a carry trade is all about. But the market went down on it, so everybody is about carry trade.
Yeah.
Market went down with a gap, didn't recover for about 7-8 trading sessions. But in the last couple of sessions, it has kicked up and pretty smartly too.
Right.
So it seems that we are returning to business as usual. And now, of course, the much awaited event would be a breakout past 25,000.
Right.
Which will once again get the juices flowing.
Right. Mr. Narayan, I want to talk about fund flows at the moment. Usually when we see such sharp rallies, such strong rallies, you usually have the support of foreign investors. That's been lacking because if I consider the kind of inflows that we've seen on a financial year-to-date basis, it's barely $600 million on a net basis. And we've seen markets rally despite that. Do you think that these investors are perhaps waiting on the sideline to wait for a correction? And do you think that that could eventually be something that could provide the next leg of rallies?
Well, I think everybody has been waiting around for correction, and the fact that all corrections are getting bought into, however limited they have been, is proof enough that there is money waiting at the lower end. Now, where is this money coming from? Definitely not the FIs.
Yeah.
They come in and do their stuff periodically now and then, but then, like you mentioned, they are net, very small positive for the year, and I think I read August is a net negative.
Right.
Some 21,000 crores. So they are not the key movers of the market right now, although historically they have been the biggest movers of the market.
Yeah.
What has had, transpired over the last 3-4 years is this deluge of money coming from SIP accounts and and allied. I think that has completely changed the game, and therefore FIs as a factor has been pushed into the background.
Yeah.
Now, I think personally, and I think the rest of the market thinks it too, because they are not having an impact, their selling is not having an impact, is perhaps the market thinks that their return is inevitable.
Right.
You know, their backyard is now giving them about 4% yield. So why would they go and seek some, slightly better than that anywhere elsewhere in the world?
Sure.
But then now we have these indications that there'll be rate cuts and all that, and bond yields are coming off in the US. So I think by the time it slipped beneath 4% and all that, you will then start having positive noises in that area that FIs will now have to come back.
Right.
Now they all deserted the market, so to speak, at much lower valuations. And they were perhaps thinking that at that point of time that was rich valuation and they'll get it cheaper. But that has not happened. Valuations have been moving up, and now there is lots of justification that this is fair. 20 times, 21 times, everybody has their own theory about what is right and what is not. But the key element is there is liquidity coming from the people, which is a completely new element. And this is forcing the domestics to keep buying. And they are able to absorb everything that the FIs are throwing at them, as a result of which there is absolutely no pressure on prices. And so long as prices don't fall, people remain sanguine, and everything is getting bought into.
Right. Of course, we must remember that what the markets are also factoring in on a fundamental basis is the possibility of rate cuts in India as well, year down the line. A couple of years down the line. We've already had a reasonably strong showing when it comes to earnings too. So fundamentally, a lot of these factors are also playing in favor of Indian markets. But from there on, we shift focus to one particular sector, which Mr. Narayan has in fact identified in the long run, which could have a potential for a significant run up. This is the films and packaging sector. Can you tell us a little bit more about this?
Well, you see this packaging films area, that's a hugely swinging area in the market. It's very seasonal. And when the seasonality kicks in, the gains are tremendous.
Right.
One, they are well patronized. So you have this very, let's say, popular names, Polyplex, Jindal Films. You got Cosmofuzz, you got Uflex, you got Ester Industries, you got several names, and all of them have been doing reasonably well. Now, the reason I'm interested into this is that at, let's say, close to 25,000 on the index, you want to buy stocks not which are making breakouts. Of those, you got plenty, right? You are, spoiled for choice for looking at breakout stocks. But breakout stocks come with their own risk element kind of packaged in. So at this juncture, one would be comfortable looking at something which has drawn down substantially. Now, drawing down in prices is one thing, and drawing down in the in the cycle or in the trend is quite another. Now, if you take a look at this, let's say this packaging films industry, they were going great guns prior to 2020. So fantastic levels and people making money hand over fist. And that's typical within this industry. When the season is good, they make, truckloads of money, and then when it is bad, they lose badly also. Keeping in line with the normal thing which happens is when your industry is doing well, everybody expands, puts in new capacity expansions and all that. And that happened to the films industry also. So everybody built new capacities, and all of them came on in a year, 2, 3 years. But by that time, COVID struck. And this whole space went for a toss because supply chain disruption happened, demand destruction happened, and everything happened. And as a result of which, the pricing of these BOPP films, the BOPET films and all that, they dropped substantially. The FMCG and auto and a wide variety of people who consume these, they also started doing badly. So that whole thing was a kind of a downward loop. And after peaking out, many of the stocks, they did so somewhere around 2022. And then for the past 2 years, they have been hitting a series of lower tops, lower bottoms, and going down in a heap. And the pullback in prices has been ranging from as much as, let's say, 40–50% down to a minimum of 10%. So all of them are well dropped down, and the time limit for the correction has also been pretty decent. Now what is happening in that area is that prices are finding their feet. If you read the commentary of most of those, the companies, all of them in unison have been saying that we are seeing now sort of green shoots.
Right.
And there is a turnaround. There is a turnaround in the end user. There's a turnaround in the prices of all these BOPP. And they typically, kind of pass on the increase in the raw material costs to the end client. So they are not overly affected. So there is a turnaround within the industry. Now, it may still be a bit of a fledgling, like prices fell from 40, 50 to 10 rupees, and then 8, 10 rupees, now they are up some 12 or 13 rupees. BOPET films are done better. They have gone up from somewhere around 10 rupees to about 20 rupees a kilo and all that. So there is an improvement, and recently, if you see the last set of quarterly numbers, last quarter number only, taken collectively, they are more or less, kind of even. There's really no aggressive change in the numbers. But then you're talking about all the managements who are looking ahead with a lot of expectation. Price rises on the mend, and stock prices are on the mend.
Right.
Eventually, fundamentals get reflected in stock prices.
Absolutely.
So, which is why, doing a technical analysis study of prices gives you an idea where fundamentally things are on the mend.
Right.
And I'm finding that within the whole of the, let's say, packaging film industry, and that is why my interest, it is an interest, it is an area which is well patronized, well followed, and then B, when the going is good, they really make a lot of money.
Right.
And C, the stocks perform extremely well when the cycle kicks in. I think all those things are getting ready. We have the first of the rises which has happened, and I think it's a place to pay attention to.
Right. So, since we've spoken about this particular one, let's pull up a handful of names and see how they have done over the course of the last 3 to 4 years. Because, well, they say that the trend is your friend until there is a change, and that's where around the bend. And I want to actually talk about the recent strength that we've seen in a handful of these counters. So if you disregard what's happened in the last 3 to 4 years, and so this is of course a chart of Uflex, which is actually showing a decline, and now it does seem like it's moving back towards its highs it made several months ago. Let's put up something like an Ester or Jindal Poly, and we can actually see that there's been an ever so slight up move in the recent past few weeks. And as Mr. Narayan was also pointing out, that there's been a little bit of a change in the fundamentals too, and that has actually led to a little bit of an improvement in terms of its prices. Though a lot of these companies are very far away from their life highs, but the fact that you're actually seeing, firstly, as you'll notice, a lot of these companies are actually seeing consolidation for many weeks and months, and after that, you're actually starting to see a little bit of buying return. So that means that a lot of analysts call this a distribution phase, and it does seem like that seems to have come to an end, and now it does seem like buying has returned to a lot of these companies. If you consider all, the group of these stocks, what are the stocks that you think are poised that perhaps could outperform its peers, the rest of the bunch?
Well, like we mentioned, there are a bunch of stocks which are already meeting up with some interest in the market.
Right.
Now, my personal pick among this whole lot is Uflex.
Right.
And the reason is more technical in nature rather than fundamental. Fundamentally, they're all similar. Everything is improving. They've all been maintaining, except I think Ester, which has been in a loss.
Right.
And I think Uflex also last quarter, there was a bit of a loss. So it would, kind of pick up later. But the key reason is, if you look at all of them as a group, now they've all had big declines. Like if you take Polyplex, which is one of the most well-patronized stock within this pack. Polyplex actually from the high in 2022 declined by about 42% from its high, which is like quite big. If you take Ester, that had a decline of something like 58%. In contrast to that, you had Cosmo First and let's say Jindal Poly or something with about a 20% decline from the high.
Right.
Uflex is unusual in the pack that it had only a 9% slide from the top.
Sure.
So this straight away tells you that whoever are the holders of Uflex or whatever is the view towards Uflex in the market is not as bearish as it is with respect to the other companies.
Right.
So that is point number one.
Right.
Now, you come to the point on the same set of charts as to what is the recovery after this big fall.
Right.
because a fall being limited is one signal. The recovery from the fall is quite another signal, and collectively they give you something more.
Right.
So if you look at the recovery, then Polyplex again has recovered about only 23.6% retracement of the whole fall.
Right.
You have Cosmo first, which has gone till about 50%. You got Jindal Poly, which has gone up to 38%.
Right.
You have Ester, which has done about 55%. And you have Uflex, which has almost completely retraced the whole fall.
Right.
So Uflex high, if I recall correctly, was somewhere around 775, 785, somewhere there.
Yeah.
And we are currently trading in Uflex at about 750 already.
Right.
So Uflex is the one which has also shown the max amount of recovery.
Right.
Which means that in the fall, nobody was very keen to sell, and in the recovery, they are very keen to buy and sending the stock up to the previous levels.
Right.
Now, Uflex is within shouting distance of making a breakout to the new highs.
Right.
Now, of course, that will need triggers. Now, that will come with the next set of results, quarterly numbers perhaps, that may come with some news about continued rise in the price of these films, etc.
Right. Right.
So, this is not something that I'm looking at, kind of performing immediately.
Right.
Now, these are all recovery stocks, and if you also just go and do a search, these were well-tracked stocks in the past, but you will be hard-placed to find a buy report in any of these names in the recent past.
Right.
That means they have all dropped out of sight.
Absolutely.
So that means too much of ownership does not happen. So this is the first flush of advance where stocks are getting bought into.
Right.
Now, after some news flow will come, and then all that flow will happen. So I'm looking at this across the next 1 year, 1.5 years kind of play, where stock prices can, which are down and out, can at least reach some decent levels.
Right.
But Uflex being at the head of the pack, I think that will push on to new highs.
Right.
And then we will see some, new sets of, let's say, volume dominoes or buying domino play out in that stock.
Right.
So that's how they are placed collectively.
So, Mr. Narayan, want to address risk management in this case. A lot of traders and investors out there firstly struggle in at what point in time should they add on to their existing position. I'm assuming that you would recommend that they add on to their existing position not when the stock is falling, but when the stock was rising. And secondly, the exit strategy, that perhaps is the biggest struggle out there. At what point in time do you decide that the stock has had its run, it's seen enough, and that's when you decide to either partially or completely exit?
Well, see, exit, unlike entry, is a very individualized decision.
Yeah.
Because everyone has their satisfaction level of what is profit.
Yeah.
Whereas there can be a decent amount of consensus about where it is to be bought.
Yeah.
Because on value, based on what they read, whom they listen to, etc., everybody gets an idea of that stock A or B is at a certain value where it should be bought, the risk is low and all that.
Yeah.
But when it comes to exit, there can be a variety of items to be considered. One, of course, is the personal level of satisfaction about what is the amount of profit that I seek.
Sure.
Now, that's fairly arbitrary, and there can never be a rule around it.
Right.
It is tied to the individual's, individual's account and where he is in the whole rainbow of things. Otherwise, the typical exit strategy which is applied is when there is a fundamental change which happens.
Right.
Now, fundamental changes to manifest take a little time, and it is only the people who do a deep dive into it can spot some changes in trend. So, that will require certain amount of skills which is not there with most people.
Right.
So, exiting near the top therefore becomes one of chance, and for a few people by design.
Yeah.
So, let's leave that also out of the equation. So, that leaves us with the rest of the people who look at overt signals of a change in trend.
Right.
Now, these overt signals of change in trend can come from the chart, can come from valuation discomfort, can come from a point vis-a-vis the market as a whole, etc. So, there are so many points. Now, if you take the market as a whole, that is doing gloriously well.
Right.
So, the market is not signaling an exit in most of the counters, but it is also a fact there are many stocks which have been blazing away and are way out of whack with valuation.
Yeah.
Now, what valuation is the peak valuation? Who has an idea? Nobody.
Right.
So, there again it becomes an educated guess. So, I think the best way to look at it at least in my opinion, because I may be biased since I am, by nature a technical analyst
Right.
and looking for weakness in trends.
Sure,
And that too trends over a longer period of time to tell me that things are not as rosy as they were in the past.
Right.
And you can find that out if you are decently adept at, studying charts and finding out and being able to look at longer term charts.
Right.
I think there are a few, kind of pockets in the market which are showing that sort of signals. It really depends upon whether you believe what you see.
Right.
Right. So there again, the subjectivity comes in. But I would say, if valuations are considerably out of whack, that people are nervous to buy more at this level. B, if the trend starts to falter for whatever reason, known or unknown as of now. See, fundamentals are what are known today.
Yeah.
But there are so many unknowns within the fundamentals which are known to a few.
Right.
The actions of those few, when it is reflected on the charts on a more consistent basis, that is what will tell us on the charts, if you do a deep enough study, that things are not as good as they were before. And perhaps it may be time to take some money off.
Right, absolutely. I reckon, the final thing that I want to touch up was on what could potentially be an end to a theme, and that is the defense sector, because we've actually seen a whole lot of these companies like Mazagon Dock, Cochin Shipyard, Garden Reach Shipbuilders come off significantly from their highs. What is your observation here?
Well, undoubtedly, the defense sector has been one of the biggest in terms of delivery of profits, and that, they've all gone up 20 times, 30 times from, the basis that they used to maintain. It's also moved from among the most hated to the most loved.
Sure.
That's a kind of rainbow that you have, which sends out warning signals that you should be a little bit on the alert. Right now, if you look at it on the charts, the pace at which things are changing and the kind of trend strength which is showing up in all these stocks, that is starting to slacken. Which is not really a surprise, because, all technical tools measure cycles. And cycles tend to show up on the charts in the form of some divergence patterns. But divergence has to be married to a trend change. Now, what you are having is part A of the equation in many of these defense stocks, that they are starting to show you that the cycles are starting to weaken or falter a bit. But there is no trend reversal yet. Now, trend reversal needs triggers. Now, that triggers can come after a little bit of price decline, or the price decline can happen alongside a trigger. How it will manifest, we have no idea. But we are seeing signs of some kind of exhaustion starting to appear in all the defense stocks, not just the few names that you mentioned. Now, I think they're all running on residual momentum, which has been, kind of built in. And that is never a very good signal for you to enter from an investment perspective. You can still get into an HAL and a GRSE and trade them for a couple of days of upswings and all that. But is it a time to invest into all these stocks, look at that 80,000 crore order and then jump into something? I would say most definitely not. Wait for a pullback. Will it come now? I have absolutely no idea. But if I am a betting man, if you ask me, will the pullback come in sector A versus sector defense, I would bet for sector defense.
All right. Okay, sir, we leave it at that. Mr. Narayan, thank you so much for joining us and taking us through your views. And of course, the big sector identified here is the packaging film space. So we will be watching out for that one. Thank you so much for joining in. With that, it's also a wrap on this edition of The Chartist, but lots more lined up on the other side. Keep watching NDTV Profit.